Good morning, everybody.
Morning.
Morning.
How are you today?
Good, very good.
So, God made realtors. God made mortgage brokers to be the realtor's best friend. All right, my topic today, after you gave my great introduction, is basically how to go over what I have seen in my years of experience in today's evolving market, the 5 main challenges that the consumer has in their financial situation today to get a mortgage. In addition to that, I'll go over a few tips on how to help yourself close your escrows on time and make your contingencies. Okay, 10 years ago, as you know, anybody could have gotten a loan because it was just like slinging a slingshot against a wall, and at some point that loan would stick. In today's market, the primary challenges that I see every consumer have is either their income to debt ratio is too high, they're lacking enough of a large down payment, they have a low FICO score, or their employment history is too short, they're trying to purchase a house, but they've not yet sold their residence. Also, or they have the income to show, but it's not supported in the eyes of the lender, but they've got a large cash down payment. From my experience in today's marketplace, only about 35% of the transactions will hit the actual bullseye in a normal Fannie Mae, Freddie Mac transaction. I'm going to collectively talk about how to hit the other 65% with some other unique products that are available. So this is a picture of your bullseye, and we're going to go after the other 65%. Okay, this is a first case study, and all of these are going to be case studies that we've actually done in the last 6 months. Some of these are going to be actual, some of these are going to be, some of the information is going to be a little bit withheld. In this situation, if you had a purchase of $1 million and you had an $800,000 loan amount, your principal, interest, tax, and insurance payment would add up to $53.28. Average consumer debt, approximately $800. The annual income to qualify for this would be $174,000. That's $14,500 a month in order to meet the normal ratios of about 38-43. If you had a client, let's say, who made $150,000, $140,000, but still wanted this property, under traditional guidelines, they probably wouldn't even be able to qualify for this loan, even with the rate of about 4%. Okay, to offset this, the debt, there's only 3 ways that you can change a transaction for them to qualify. You either have to, you either have to increase their income, and you can't do that. You have to decrease the amount that they owe in liabilities. With them putting the down payment, they're not going to have that ability. Or somehow you have to alter the term on how they're going to be able to repay that mortgage. So in order to fit this borrower into this transaction, we put them on a 4-year interest-only loan on a 7-1 term. Doesn't mean that they can't pay it off, doesn't mean we're trying to extend their debt. But in doing so, you extended the term, and the qualifying rate on this was $35.24. The insurance and taxes totaled just under $4,800. Same amount of consumer debt of approximately $800. And the annual income needed to qualify for this was $138,000. That's $11,500 a month. The actual minimum payment on this is about $400 less. It's $31.25. Collectively, and this is, again, in the eyes of the lender, it doesn't necessarily mean they didn't make the $174,000 a year, but in today's guidelines, we may not have been able to use or qualify them with that income. Essentially, what this allowed them to do is purchase a house, because in this case scenario, this debt ratio would be able to go up to 49%. You do need excellent credit, and you would have to have 6 months reserves, but that's pretty typical in a transaction like this. Okay, the primary factors when you would use a scenario like this is if you wanted to maximize cash flow, A good example, I have a lot of clients that work for Xerox, and if they worked at Xerox and they were getting $120,000 in salary, but you got another $50,000 in bonus, but due to the job change, you couldn't collectively use the bonus any longer. So to offset this, the interpretation to use the income is no longer there, but you can change the way that you can manifest the payment. Another good candidate for this type of transaction, or somebody self-employed, or they're not planning to stay in the property long term. Okay, this actual rate today on a purchase is 3.5%. The advantage on some cases is that they will qualify on a 40-year term, and in some cases other institutions have a 35% back-end ratio, and the reserve requirements are much higher, which ultimately makes it not easier for the borrower to qualify, but harder. In the long end result, we want to see a closed escrow. For those scenarios with, the other scenario we see a lot is when the borrower doesn't have enough money saved up. Okay? In this case, there is an economic opportunity mortgage, and that current rate is at 4 5/8, and it has no MI and no MIP. So if you have MIP, and if it's a $500,000 mortgage, 1 3/4% of that is almost $10,000. If you had 1 3/8 on top of that, which is the actual monthly MI factor, even if you had a 4% rate, that'd be an interpolated rate of 5 3/8. Higher rate, harder to qualify. You'd need a minimum of 620 FICO, but you can't have any ownership in any other property for the last 2 or 3 years. And that includes on your Schedule A, if you were making payments for your parents and you didn't own the house, that may discount you from the ability to get that mortgage. I've seen that happen as well. The borrower only needs to have 1% of their own gift funds. I'm sorry, the borrower only needs to have 1% of their own funds. You can get a gift, and you only need 1 month of reserves. Now this can be tandem with what's called a DAISY program, which is a down payment assisted mortgage. It's basically a $15,000 grant if they've been in the house longer than 3 years. I didn't bring that today, that'd be a whole other topic. The maximum loan on that is $400,000. But if anybody needed any information on that, email me direct and I can send that to you. Okay. For the economic opportunity mortgage, there's basically 2 ways to qualify for this. Does everybody have a handout, by the way? All this should be right there and there for you. Okay, this link will take you to an address. And that address, if you follow these steps, it'll take you to the eligible tracts. Within the eligible tracts, look for the light, dark, and purple areas. Now, if you look at this map, and I couldn't get a better map of this, anything in the purple, light purple or dark purple is an eligible tract. If your property is a listing, that buyer has the ability to purchase this with 5% down, all the way to 625 if they qualify. If it's not in the tract, there's an income restriction. That income restriction is as follows. It's just over $74,000 in LA County, just over $100,000 in Orange County, just over $75,000 in San Bernardino County. Okay, with this being said, about your best case scenario with 10% down, they're going to qualify for about $450,000, $600,000, and $450,000 respectively in each one of those respective counties, if they're not in the tract. If the property falls in the tract, the income restriction is not required. Okay. On the bottom of this, there's another link. That link will lead you to a website where you can put in your client's property address. Okay? On that address, it'll give you the tract number. Assuming that tract number qualifies, your borrower would be eligible for that product. Now, I didn't bring the census tract because that was like a 40-page document. So anybody who would like the tract, just email my office, put on the email, please send us a census tract, and we'll PDF that out to you today, tomorrow. Okay. Just a little bit off topic, but the same lender also has an economic opportunity for higher-end borrowers. That current subjective rate on the purchase is 80% at 4 1/8. Now, you do need high FICOs and high reserves, but 80% to $2 million is a little bit of an oddity. Okay. The other main obstacle I see in today's consumers is that if they typically have a low FICO score, or their length of employment isn't long enough. And there's a difference between having bad credit and a low FICO score. Typically speaking, if you have bad credit, you are going to have a lower FICO score. But just because you have a low FICO score doesn't mean you have a bad credit. In every case, on Fannie Mae, Freddie Mac, or on a jumbo transaction, you have to take the lower of the middle score. In this case, we had a buyer who had a 600 FICO score, and he was off work for over 2.5 years. He just started working again. How were we able to get around this? We had a solution in that we had an agreement with a lender where you could average the FICO scores. The wife's score was 720. His was 600. That brought us to a 660 average. With a good lot of explanation, because in this case it was a little bit backwards. Because the mother, or I should say the wife, was a breadwinner, but she just went on maternity leave, but because her income was larger, the husband chose to stay home for the next 2.5 years. Letter of explanation, previous history, everybody was happy. So that's one instance of how you can get over a situation, because unless you went, even if you went FHA, if your loan amount was greater than 725, you wouldn't be able to get this transaction done. So all I'm trying to show you is different avenues on how to think outside the box to hit the other 65% target. Okay, if you have a scenario where the borrower's income is hard to document, but they have a large liquidity with a minimum FICO score of 700, excellent credit, you can do transactions now where you can state the income, but you have to have assets verified. Okay? It's stated income, but verified assets. They need a few, their credit has to be, they have to have 2 years minimum history in employment. The business number has to be filed and verifiable. And they need a CPA letter to document that this person is self-employed. There is a high reserve requirement for this type of transaction. To 650,000, you'd need at least 100,000. To $1 million, it's 250,000. To $1.5 million, it's 500. And up to $2 million, you'd need another $1 million in liquidity. Okay, and the verifiable forms are basically going to be a normal checking, savings, securities. It will take up 60% of your retirement account. Okay, finally, I think I put everybody to sleep here. So wake up. Okay, how can you help yourself make all your contingencies? Well, first get your borrower pre-approved. I'm not saying it has to be with me, but in general. Because in today's environment, it's not about common sense, it's all about compliance in the eyes of the lender. And I think that's a topic I wanted to talk a little bit more about, but it's in the opinion of the lender, what is a verifiable and identifiable piece of information. And sometimes to get what is actually verifiable and identifiable in the eyes of the lender doesn't come in 2 hours. It can take 2 days, it can take 2 weeks of correspondence. The sooner you get them in, the faster that person is going to be able to assist you to close your escrow. Okay, here's a generic question. In the last year, who here has to have had a water heater strap before the close of escrow? Anybody? 1, 2, 3? Okay, so on your listings, make sure it's strapped before the property comes in. That's a common sense thing, but I've had that happen to me 4 or 5 times in the last 6 months. Another thing is, how many of you make sure that you have CO2 detectors and smoke detectors in the property before the appraiser goes out? All of you? Yes. Okay. Now here's another question. How many of you test them? Because every once in a while you're going to get that appraiser who's going to push that button. Because if it doesn't work, he can charge you again. So it's a vicious cycle, so check them, make sure they work. What I suggest is you go down to Home Depot or Target and get a case of them. You can buy them for like 25 bucks at Target, and you can get a dual CO2 detector and a smoke detector. If you're missing one, just plug it in. Whether you take it back or not after he comes in and inspection. I got that from Giuseppe. Okay, another item, make sure when you get all your disclosures, get them signed and back to your escrow and your lender immediately. Okay, recently, and about 2 months ago, I didn't get back the seller's disclosures on a 45-day escrow until day 48. They couldn't understand why we went over. But the appraiser needs to see all those items checked off. I think it's on page 4 on box 11. Just know if you check that box, right there's a red flag. That's how the lender sees it. Something needs to be disclosed. And you, the seller, the buyer need to perform. So it's not to me, but again, it's in the eyes of the lender what is necessary data and information. Now this is not a have to, but this is what I see a lot of times, and everybody gets their offers accepted on Friday, seller's acceptance, you get their signatures. Monday's a holiday, salesperson goes to escrow Tuesday morning, Tuesday afternoon after lunch, talk to the escrow officer, everybody's happy. Escrow officer gives it to the assistant. Then they order title, they order the fees, but in the eyes of the bank or the lender, the transaction date starts almost when the day the client has signed their disclosure. The disclosures can't be signed until the lender receives the exact fees on that transaction. So if you're gonna start it, do a 30-day escrow, but start on the day escrow's open. That's not a have to, it's a suggestion. If you don't, on the very back of this, there's a little cheat sheet. When you send your offer over, send them and ask for all the fees that are necessary to the lender. Give them all the descriptions, because the escrow officer, and you guys work very, very hard, by the way, need to know who the seller is, who the listing agent is, who title is, because all the collective fees are necessary. And if your fees aren't disclosed and even the transfer tax aren't exact, that disclosure to the buyer is invalid. And then there's a holding period. So now instead of losing from Friday to Tuesday, you lost another week. So in 17 days, it's really only collectively 14, actually 13, because you've got 2 weekends involved. So you've basically got 13 days to perform. And our business is about commitment, chronology or a plan, clarity, and compassion. So have compassion also for the buyer and the seller. So that at the end of this, there's a setup sheet that'll help you. And that's all I have for today. My name is Kenji Tastuno. I'll be taking any questions now.